Good morning and welcome to our fourth webinar in the Generational Wealth Training series that we've been putting together. This morning, my name is Andrew Lawson. I work obviously at RCI. I've been with the company for about 5 years, and I work quite closely with Di from a wealth management, portfolio management, and structuring perspective. The topic of today's webinar is asset allocation and alternative investments. So from a high level perspective, essentially asset allocation, how your assets are invested and what asset classes are they invested in. And generally speaking, we're referring to investable assets, but we'll touch on that just now. And then a little bit on alternative investments. Historically, alternative investments have been more limited to sort of high net worth individuals, and includes various different scenarios that we'll chat about. But more recently, they've become much more accessible by the general investor, and they have a place in portfolios, we believe. So let's get started. So what is asset allocation? As the name suggests, essentially refers to in what asset classes are your investments invested. For those of you that are clients or have been clients of ours, you potentially have seen a graph similar to the one on the screen, which essentially shows how assets are invested. We tend to look at invested assets, so we would typically exclude something like your residential property, because that's not really an investable asset, although it does have value from an asset perspective. But we tend to focus more obviously on the shares or equities in your portfolio, things like bonds or cash, bonds essentially being fixed income type investments, not equity related. Commodities, we would look at things like offshore versus onshore allocations. And from this, we get a holistic picture of what your investable assets look like and whether the allocations are correct from an understanding of your individual circumstances. So what influences the asset allocation decision? So holistically, we look at a number of components. The first one being your total wealth. So the more wealth one has relative to your requirements as an investor, the more risk one is able to take. The second thing we would look at is the age and stage of life that you find yourself in. So this would affect the present value of any future expected income requirements as well as expense requirements. So the rule of thumb is obviously the younger you are, the more risk you can take with your investments in terms of looking for higher returns over time. The older one is, obviously, the less time you would have to recover from short or medium-term shocks or losses to your assets. And so you tend to be able to take less risk. The following thing that we would look at is your liquidity needs. So the less cash that one requires from your investments, the more risk one is able to take. So if you have, for example, school fees that need to be paid, you can't afford to invest those assets, or that component of your assets, into an asset class that may reduce in value and leave you with a shortfall in terms of being able to pay school fees. If you don't have specific liquidity needs, then obviously you can take more risk. The other thing that we would look at is the tax implications of doing things. So often when we meet clients for the first time, you already have invested assets. To be able to change the asset classes that you're invested in often have tax implications, and then the ongoing tax implications as well. So if you were to earn taxable income because of the investments that are made, your personal tax situation feeds into the decision in terms of what asset allocation makes sense from an after-tax return perspective. The other thing that we would look at, and this is, I suppose, where we see lots of scenarios from a client perspective, is your unique circumstances. So this could be anything from if you had a special needs child, or if you were having to help look after your parents, or a sibling who was unable to work for whatever reason. Each and every investor really does come with the specific unique circumstances that one needs to take into account. Obviously, depending on how those circumstances play into your needs in terms of liquidity, that obviously influences the amount of risk that one can take in terms of an asset allocation decision. And these factors basically filter into the risk return decision that then gets made by the likes of ourselves in terms of an advisory kind of perspective, in terms of how much risk and how much return is required from your assets in order to be able to provide for your liquidity needs over time, as well as to hopefully be able to grow your asset base and wealth. So how does it work in practice? Essentially, we have this sort of simple graph which shows that for an increasing amount of risk, one expects an increasing amount of return. So on the left-hand side, we have the low risk, low return type of investments. And in this perspective, we would be looking at something like cash in the bank, for example. So cash in the bank is essentially no capital risk. So your 100 Rand will always be there. But the return that you would expect to get that, and especially at the moment with low interest rates, is that you would expect to get a low return. But it is quite guaranteed. As you move up this curve, and this is it's a dynamic process and it's a dynamic decision-making scenario. It's not a static process by any stretch. The higher up the risk curve one goes, the higher potential return one expects. Note that we talk about the potential return because it's definitely not as guaranteed as the lower risk cash in the bank kind of scenario. The higher risk investments tend to reduce from a time perspective. So the longer your time horizon, the more chance there is that those higher risk investments will yield the higher potential returns. So again, goes back to the scenario, if I need to pay school fees next week, I definitely can't afford to take a high risk with that amount of capital, and it would be cash in the bank would probably be my best bet. So where do the different investment categories sit on this curve? So like I mentioned, cash in the bank basically sits at the bottom left of this curve. What you'll see is that on the very left, the number is essentially positive. In a South African context at the moment, you can probably get around 3 or 4% return on cash in the bank earned as interest, which is taxable. But if you go and look at somewhere like the US or the UK, you potentially are getting 0 or even negative returns on cash in the bank. And so this forces people to have to move further up the risk curve to get a higher return that is going to sufficiently generate income for your requirements. So the next component along this curve would be bonds. Essentially, bonds are debt instruments issued by governments. So in South Africa at the moment, the government is issuing bonds that will generate a yield or a return also in interest terms and also taxable of about between 8 and 10%. It sort of depends on the day in the market. But you can sort of safely expect to get about 9%. But it does come with more risk. So you may have months where you have a negative return, although they would not be as frequent as what you would expect with any of the investment classes further up this risk curve. The next thing that you potentially could invest in is debt. Here we're talking probably about corporate debt. So companies that have gone to the market to raise cash, they would theoretically have to pay more interest in order to raise that money than what the government would, because there is a greater degree of default that a company could go bankrupt. But that tends to be an investment that we would not be making from an individual kind of client perspective. And that would be the kind of debt or kind of investment that you would find more in a unit trust environment where you have a professional fund manager who's able to access those debt markets and instruments. The next thing along the risk curve is property. Property historically in South Africa has been a great investment. People have made lots of money out of property. But what we have seen is that property market has obviously taken a bit of a hit over the last couple of years. And it's debatable from an asset allocation perspective, from our point of view, especially where you have, if you were to look at your total assets and you had a primary residence in which you lived, which probably makes up a fair component of your asset base, we would historically or currently not really be advising people to be investing in investment property. This, as I said, this risk return curve is a dynamic sort of process. So also as things change, so potentially the following investments would all sort of move along this risk curve up and down, depending on where you were in an economic cycle. And so property at the moment might even be considered sort of more high risk in a South African context. Next along the curve would be your standard sort of equities. So there we're talking about your JSE kind of listed stuff. We would also be talking the same kind of risk return graph applies obviously offshore. So again, you'd be talking offshore equities. And we'll chat a bit more about that because that tends to be where our focus is as a company. Higher up the risk return curve, we would head up into the sort of private equity, venture capital kind of realm. And here we would be talking largely about the alternative investment world, which we'll touch on a little bit later. Just as an interesting fact, so the US has historically used a 60-40 split when making pension fund, retirement fund investments. The 60-40 split, essentially 60% of equity exposure and 40% of bond exposure or fixed income. So there would be some debt component in that. But because of the reducing returns that they have had on cash and interest-bearing investments over the years, they currently, as at the end of 2018, they sat with about a $1.2 trillion shortfall in terms of pension funding. So part of this risk return equation is to make sure that the investments that one is exposed to are going to keep pace with inflation, obviously being the one key component, but also in terms of your real cost increases. So what you've seen in that kind of world is that something like medical care or educational costs have increased far in excess of inflation or CPI. And as a result, where you're earning relatively guaranteed yields on interest, but at lower rates, that your investments just haven't kept up with your actual cost of living expenses. So this is a very, very important consideration when looking at your total assets in terms of making sure that you are exposed to the right risk return equation. So again, this is not a static process by any stretch of the imagination. And within each of those categories that we've just discussed, you again sit with different components to those categories. So if we look at the equity side of things, which is where obviously we are more focused on from an investment point of view, you would still have a scenario where you have lower risk or higher risk investments with the expected returns also mimicking that. So the lower risk, lower return scenario. So what are we talking about? Large cap blue chip shares. So the NASPers, although NASPers maybe we could argue sits further up this risk curve, but something maybe like a British American Tobacco, an Anheuser-Busch, your banks, there's relatively little chance that they would go completely bankrupt. And there's a pretty good chance that they would be able to pay a reasonably sustainable and predictable dividend yield and an earnings number that you can forecast with some degree of certainty. Going further up that risk curve, you would have something like mid-cap equities. So from a South African context, there we're talking things maybe like a Dis-Chem or a Clicks or a MultiChoice, where there is more risk involved, but we do expect a higher return. The return doesn't necessarily come from income, and that is also something that we'll touch on in a minute. Further up the risk return curve, we have small cap equities. So that would be something like a long for life, for example, in South Africa. And there the risks are much bigger, but the return is also expected to be higher. So from this perspective, looking at this kind of scenario, we end up in a scenario where we have to make a decision from a portfolio management perspective as to what components of the equity market should you have exposure to. And that's where we would rely on someone like Mike as the analyst kind of person to find us what we think would be the right risk-return trade-off to take for various different companies that we would invest in. So one of the things, obviously, that is important is diversification. So how is diversification achieved? What does it even mean? So essentially, you don't want to have all your eggs in one basket. It's one of the most commonly discussed investment questions about what is sufficient diversification. And it's an interesting one because it's quite contentious. It involves looking at things like single stock exposure. So do you have a share portfolio that has excessive exposure to a single share? So we would find that, for example, if you were a director of a listed business and you got share options over a career, you may well end up in a scenario where you have a portfolio where the majority of your investments are in the company that you worked for. And from that perspective, the diversification question or the answer is probably that you have too much exposure to a single stock. One of the other components to look at is, do you have exposure to a single investment manager? And are you comfortable with that? Some clients prefer to have different pots of their money with different investment advisors, who each investment advisor will have their own theory in terms of the investments that are being made. And so that gives you some diversification away from a single person potentially making a bad investment decision. Interestingly, in the world of diversification, if you think of the wealthiest people in the world, so thinking about Elon Musk's, the Jeff Bezos's, the Bill Gates's, they essentially had zero diversification. So the argument can be made that diversification actually is not the right way to go, but those are probably a handful of people that are not applicable to the average investor's scenario. The way to think of another way to think of diversification. So I look at myself, my personal situation. So my job and future earnings are very much tied to stock markets, being in the investment advisory world. And so if I was to present value my future earnings, essentially my total asset base would be exposed to stock markets. And so maybe from my perspective, stock markets should not be what I should be investing in with investable money that I have today. There is no short, specific answer in terms of what diversification is correct. Also, the next question really to consider is in terms of local and offshore diversification. So as a business over the years, we have been much more focused on moving money offshore and investing overseas for clients. If you look at the JSE as a sort of component of world stock markets, it's a tiny, tiny number. So you're talking probably 1 or 1.5% of the global stock market value is sitting in the JSE. And so from that perspective, to have a portfolio that is entirely focused on the JSE or South African equities probably means that you have a diversification issue and that you should be looking to get exposure outside of South Africa. That's really excluding the potential for investments that we see being much better offshore. In terms of clients that we deal with and how we look at things, historically, lots of investors have had direct share portfolios, which has been it is generally a good way to keep costs down, and it has been a sort of a preferable investment route for many investors. What we've seen over the years is that you end up with various different issues having a direct share portfolio. Obviously, there is a tax implication. So being able to make changes to a portfolio often comes with tax implications because of capital gains that have been realized over time. And so we have sort of taken a view that often it's easier or better to be invested in a unit trust on the basis that the unit trust manager can make investment decisions without triggering tax consequences. So you can be a little bit more proactive in terms of what investments you're exposed to at any particular time. One of the questions that does often come up is that being invested in a unit trust doesn't give me the same diversification, which I would argue is not the correct way of looking at things. So where you have a direct share portfolio that, for example, RCI was managing, if you had a single unit trust that RCI was managing, you probably have more diversification in that unit trust than you do have in a direct share portfolio. Although on a statement, it looks like you've got one investment as opposed to 20 that you had in a direct share portfolio. So from that perspective, unit trusts are a good diversification tool on their own. The next question is, do I need 5 different unit trusts? And partly that is a question of comfort in terms of the investment manager. So are you comfortable with all your eggs sitting in one investment manager? But partly it's also a question of costs. So unit trusts do come with some additional costs. There are administration costs involved that can't be avoided. And so it becomes a bit of a toss-up as to what you feel comfortable with as an investor. But from our perspective, a unit trust is a great diversification tool on its own, even if it is an investment in a single unit trust. Often diversifying things also doesn't lead to a good return outcome. So if you were to have 5 stocks in a portfolio or 10 stocks in a portfolio or 100 stocks in a portfolio, the 100 stocks scenario gives you less opportunity to benefit from good returns in individual businesses. It's it almost touches on the scenario of, do I invest in an ETF, which is exposed to every company in the market, or do I have a more concentrated investment focus? And it's a how long is a piece of string kind of question. In this day and age, what we've seen over the last few years is where markets are going up and up and up, especially offshore. ETFs have not been a bad place to be, but when markets correct, and at some point they will, potentially you are in a much better position not being exposed to the full market or the whole market. Also, what we see from that kind of perspective is something like if you were to invest in an ETF in China, and China's been top of our minds recently with all the regulatory drama going on there. But if you were to invest in an ETF of Chinese stocks, you are largely exposed without necessarily appreciating it to the big industrial companies or banks in China that are essentially government owned or controlled. which comes with a whole lot of additional risks that people don't necessarily appreciate from an ETF kind of perspective. The risk, obviously, on the flip side of that is that you're invested in a handful of companies in China that underperform the general market. So that's that on a asset allocation and diversification kind of perspective. Just one or two things that I thought I would touch on is from a client return perspective. What we see is, what we have seen over time is that historically there was quite a big focus in South Africa in terms of earning yield, so dividend income or interest income, to fund your required expenses. What we've seen obviously over the last year with COVID is companies can and do cut their dividends if they have to. Interest rates have declined. And so the income generating potential of a portfolio has potentially reduced. The other side of that equation is that where we're investing offshore more so than South Africa, a lot of the businesses that you're able to invest in there are more technology focused, and that is a focus of our sort of investment philosophy. And a lot of those businesses just simply don't pay dividends. So something like an Amazon, one of the biggest companies in the world, doesn't pay a dividend. The reason they do that is that they think they can reinvest the money that they make into and produce a better longer-term growth outcome in their earnings capacity rather than paying out excess cash to shareholders. So how does that affect the way that we look at portfolios? We tend to look at things from a total return perspective. So if I have 100 Rand invested today, would I rather have 150 Rand next year, but I've definitely earned my 10 Rand of income over the year, or would I rather have a total invested portfolio of 200 Rand at the end of the year? And from our perspective, obviously the 200 Rand is better than the 150, but it does come with the fact that you don't receive income necessarily to fund expenses. And that means that you would be selling down on investments to fund those expenses. Whether the income or your liquidity requirements come from selling down of shares that have produced returns or from dividend income, from our perspective, is neither here nor there. It's which option would give you the better longer term return. So, for example, what we see a lot of is so let's take British American Tobacco, for example. They're going to pay a dividend that you are relatively secure. We know will be about, call it 8%. And we know that cash will come into the portfolio. But we also know that their earnings capacity or potential is relatively small. So they are sit in a declining industry. Less and less people are smoking around the world. And they make their money really by increasing prices every year. Obviously, I'm simplifying things a bit. There are other components to their business, but just from a simplistic sort of point of view. So if I can get 8% dividend yield and let's say 8% earnings growth, we're looking at a 16% return for the year. Whereas we can forecast with relative certainty that something like a Microsoft, which is not a small company by any stretch of the imagination, is probably going to do the similar, if not better, kind of earnings growth, but at a much lower dividend yield. And from that perspective, potentially a Microsoft is then a better investment option in terms of the value of your portfolio growing over time. Moving on to the alternative investment side of things. So this is historically has been a very, very complex and complicated realm of the investment world. It's also been largely unavailable to the majority of investors. So in America, for example, you have to often be an accredited investor. So you have to have investable assets of about $1 million to qualify as a accredited investor, which by implication excludes a huge percentage of the population. that is changing and has changed a lot. I'll talk a little bit about why and one of the things that is driving a lot of that change. But in very broad terms, alternative investments basically encompass non-traditional asset classes. Non-traditional being the equity and bonds components that we've just talked about. So it would be things like private equity, venture capital, structured products, and it could even go as far as something like art or wine, or more recently, the world of cryptocurrencies. Sorry, going the wrong way. So I thought we'd just touch a little bit on structured products. So the graphic there of the stock market crashing refers to 2008, the global financial crisis. So in 2008, essentially the global financial crisis was driven largely by structured products where there were collateralized debt securities and collateralized mortgage obligations that essentially collapsed and caused the global financial crisis. They've got a very bad name as a result, and they can be highly complex products. But as the US stock market continues to make all-time highs, the risk-return equation from a direct equity investment becomes a little bit more complicated, and the returns potentially, the expected returns potentially reduce. And from that perspective, it starts to make these kind of products a little bit more appealing as a component of a total portfolio. So to give you an idea of what I'm talking about with a structured product, at the moment, there are as many of these different things as you can dream of. But I thought I'd give you an example of one type of scenario that we've come across recently that we think could be quite useful to clients. So the way this particular one works is you would select a basket of shares. So you can choose any shares effectively that you want. But the way that we would tend to look at this is you would select a basket of shares that you would still want to own long-term in a portfolio. So in this case, I've chosen Amazon, Microsoft, and Alphabet or Google. Those are three shares that would be of relatively significant weight in the average offshore portfolio that we look after. So we wouldn't have an issue in terms of owning them. And I'll come to why I say that just now. Once you've selected the basket of shares, you would select a period that you want this product to run for. So you can choose 3 months, which is quite short, obviously, 6 months or 12 months. And by being able to select a period as short as 3 months, you take quite a lot of the risk of something negative happening over the period. So it's relatively, and I say this with a disclaimer, but it's relatively easy to predict what will happen over the next 3 months with an Amazon or a Microsoft or a Google, more so than it is over the longer term in terms of if there was a total stock market correction. So once you've selected a period, you would select a barrier. So to explain a barrier, if a share was worth 100 today, the barrier that you can select essentially determines from 100 down what would the triggering barrier be. So if the share was 100 today and we said we wanted a 60% barrier, you would be effectively talking about a share price of 60, not 100. The different barriers that you select would change. So all of these components, depending on what you select, change the outcome of what the product produces. But by being able to select something like a 60% barrier, it would be very unlikely, in our view, that something like an Amazon, Microsoft, or Google would drop 40% over a 3-month period. And this is all done online. So you would log into a platform, you can select any shares, so it's not specific to only something that's being provided by a company that has a vested interest in this. You can choose any basket of shares, you can select virtually any period that you'd like, and you can select any kind of barrier that you'd like, and you generate a product. What it does is the product essentially buys and sells options or in the background, and it gives you an upfront yield that you would receive at the end of the period. So by selecting the basket of shares and the period of 3 months and a barrier of 60%, you could potentially earn an income yield, so essentially sort of an interest number of, depending on what the basket of shares are, depending on the period and depending on the barrier, between 2 and 8% per quarter. So compare that to essentially getting 0% on cash in the US. It's a very tempting or very appealing yield to be getting. What happens in the worst case scenario? So the worst case scenario is that at the end of the period, not at any point during the period, at the last day, so let's assume 3 months later, if one of those shares is lower than the barrier that you've selected, you would end up owning that share. You would still receive your income yield, so you would still get the 2 or 8%, but you would, instead of the product just lapsing, you would actually physically own the share. Is that a terrible outcome? Well, where you've selected shares in your initial basket that you would be happy to own anyway, potentially not. Obviously, you don't want to be exposed to too much of a particular share, but this is from a short-term yield kind of perspective, this is something that is quite attractive to many clients. And it becomes more attractive as stock markets continue to make new highs, and it becomes more and more likely that there is potentially less return available from owning a share directly. You can also do this by borrowing money against your existing share portfolio. So borrowing money offshore at the moment, you're going to be paying about 1%. So if you can get without having to sell anything or realize any gains on an existing portfolio to fund something like this, you can borrow from your existing portfolio at about 1%, and you can earn a yield well in excess of that after all costs. And so it becomes quite an attractive product. Obviously, this is sitting much further up the risk curve than cash in the bank or direct equity portfolio that you would most likely see in your portfolio. And then, so the last thing that I'd like to touch on today, Di obviously dragged me into this. In her first thing, she said I'd talk a little bit about Bitcoin. So I'm not really going to talk about Bitcoin, but I'm going to talk generally about crypto. So crypto essentially sits as an alternative investment. And it's a fascinating scenario because largely due to crypto, you have got away from the scenario of needing to be a high net worth individual to be able to invest in these kind of assets. Effectively, anybody can do it with a laptop, with a bank account to be able to get money in and out. You no longer need to be the investor with $1 million asset base before you can start looking at investments. This sits far way off that risk return curve. So the risk is much higher and the return is expected to be much higher, potentially, but it does come with obviously all the added risks. It is largely unregulated globally, so it's very difficult. It's not necessarily the kind of thing that we can't invest for clients. There are certain things that are slowly coming to market that do allow you to, but you can't do anything too fancy from an investment point of view in terms of us managing money for you. But it is now in excess of a $2 trillion asset class, essentially. So how does this all fit into things, and how do I see crypto as an alternative investment given the risks and expected returns? So I've put together a little graph here to show how I think one should look at this. So what I've done here is I've taken a selection of 5 different investments, and this is the thousands of different cryptos out there, but you can go and do some research, and once you're comfortable with a handful of them, if you were to take 5 investments and invest 100 Rand into each of them, and 2 of them went to zero, which is highly unlikely because if something started going down towards zero, you'd probably sell and recoup some of your money. But let's assume two of them go to zero. One of them goes up 3 times, one of them goes up 5 times, and one of them goes up 10 times, which, to give you an idea, so a 10-time return is 1,000%. It's not the kind of return that one would ever expect in the stock market. But given that scenario where your 2 investments have gone to zero, but the others have made multiple returns, you're looking at a total return of 260%. The time frame here is sort of irrelevant. I'm not. It could be, these things can happen quickly in the crypto world. They can also happen slowly, depending on which assets you were invested in. But that 260% return is roughly equivalent to earning 8%, which is more or less what you would get out of the US market on average over time. It's roughly equivalent to 16 and a half years of being invested in the US stock market. That is with 2 investments going to absolutely zero. So from that perspective, having a small component of something like crypto potentially makes sense to people. Obviously, this sits very, like I say, sits very far off the risk curve from our perspective, and being unregulated, we really can't go into too much detail about how to look for these investments or what to do. But just to give you an idea as to what's out there, this is changing dynamically all the time. It is becoming a more accepted investment globally, but also obviously comes with all the standard disclaimers. And what's next in crypto? Where do I see things coming? So just there are lots of acronyms that float around. The one that I think is sort of has the most relevance these days is something called DeFi, so essentially decentralized finance. And essentially think about anything to do with banks. So banks are, if we were to look at a bank purely from a profit perspective, a bank is generated, the banks globally are generating huge profits. They're paying dividends to customers, but they also come with their risks. But you're earning no interest whatsoever on US dollar cash sitting in a dollar cash account. In crypto, you can essentially go and buy one-to-one backed US dollars and earn 8.8% on your cash without really taking any crypto risk. So why would you, as a US investor, to be earning almost 9% interest on your US dollar cash almost becomes a bit of a no-brainer compared to putting cash in your bank account. It does come with obviously needing to know how to do it, but these things are becoming more and more simple. The onboarding kind of process is easier. Because it's unregulated, the rules and regulations in terms of being able to invest in them are slightly different. And so these examples that I give that are on the slide at the bottom there, so Tether is a US dollar one-to-one, essentially one-to-one backed currency. Not 100% backed, but same as banks don't back your deposits one-to-one. But that's earning about 9%. Pounds, you can earn about 9%. Euros, US dollars, you can also earn about 9%. And then to give you an idea, so Ethereum, obviously one of the big cryptos, that you're earning about 5% at the moment. Bitcoin, you can earn about 3.5%, 4%, depending on where you're invested in. So that just gives you an idea. And the reason those yields are available is purely because you're taking the middleman out of the picture. So banks are making profits because they're not paying interest, or they're earning the differential between the interest that they're charging and the interest that they are paying, and they're earning profits. So this is essentially just taking the middleman right out of the picture. And you can see the difference that makes to the man in the street who's investing their dollar cash into these kind of products. There are in the DeFi world, or the decentralized finance world, it's all maths, it's all algorithms, and the products are evolving at an incredibly rapid pace. So you are able to borrow very easily against the crypto asset that you have. From a US perspective, it's a very popular scenario to not sell assets and realize capital gains, and rather to borrow against assets because of the tax benefits. And so from that perspective, this world is evolving very quickly and is becoming very disruptive to many of the older financial institutions. You may or may not know that El Salvador, I know not the biggest country in the world, but they've recently made Bitcoin essentially a currency, an accepted currency in their country. And just by doing that, in terms of remittances that are made back to El Salvador by people working in the US, they reckon that Western Union will take about a $400 million hit in terms of fees that they are currently earning on people sending money back to El Salvador. So effectively, you can send money now from the US to El Salvador in Bitcoin at virtually zero cost versus paying your normal bank fees at a Western Union to send money back. So that gives you an idea as to the sort of actual disruption that is happening as we speak. Thank you very much for listening. I hope there was of some value to everybody. If you have any questions or queries, please feel free to get hold of us. We're happy to assist as much as we can. That's my contact details and Marika. And then just as a heads up, our next webinar will be on the 12th of October at 11:30, and Ross, our offshore specialist, will be talking about global investments. Thank you very much and enjoy the rest of your afternoon.